I am a private wealth advisor and CEO of RBH Global Wealth Partners, which is a private wealth advisory practice of Ameriprise Financial. I thought we would start off, let me just tell you a little bit about myself and my background. Excerpts of my bio are on the screen there. I am an economist by training. I spent the early part of my career working in development economics with the World Bank. I left that job 20 years ago this year to start my financial planning practice. I am a certified financial planner and have completed a number of additional financial planning and investment management designations. Our practice focuses on and specializes in working with employees of international aid organizations as well as the federal government. But most importantly, we work with our clients and encourage them to live for today while still planning for the future. And that's really what we're going to talk about today, this idea of balance between current or present and future. It really is about living for today while still planning for a future that may or may not look like what you expect. There's a lot to consider with prioritizing spending, saving, and investing, but the bottom line is that life is short, so it's important to still enjoy today while planning for and saving towards your financial future. Working with a financial advisor can help, but even if you're doing this on your own, we encourage you to take a step back and think about how it is you want to live your life so that the choices you're making today are intentional about how you're saving and spending, and you're aware of the trade-offs between decisions you make today and the impact on your future financial health. If you were to imagine a perfect financial plan that prepared you for what life has to offer, it would look like a straight line, wouldn't it? The shortest distance from point A to point B is in fact a straight line. But life doesn't usually happen that way. Unexpected things come up, and at some point all of us experience a financial detour or two. In fact, the reality of life looks more like this. And you can't always predict exactly what's going to happen or how or when changes will occur. A few of the examples of life changes that affect our financial and life plans include a job change, loss of a job, deciding to change careers or starting your own business, illness or injury. What if you are unable to continue working? How are you going to support yourself or your family if you can no longer earn an income? Family changes, marriage, divorce, birth of a child, or caring for elderly loved ones or other family members. Market volatility, changes in your savings and investments can impact the decisions you make, the income you have available both today and in the future. And Social Security is out there as a somewhat of an unknown. The younger you are, the less likely you can rely on projections of what those benefits will actually be. Because if you've read anything in the news, you know that the Social Security system, the way it's designed currently, is not sustainable and won't be able to continue to support retirees 20 and 30 years from now the way that it does today. Okay. So when we look at balancing today against tomorrow, we're really looking at the trade-off between decisions that you would make today, such as saving for the future, so that you're able to manage the income in your retirement, focusing on building your wealth today as opposed to safeguarding the wealth you've accumulated later on in life. Today you need to focus on protecting what you will earn or what you haven't yet earned versus protecting what you have earned and have accumulated when you're in the retirement phase, and how you want to impact and take care of the people that are important to you and the causes you care about versus securing that impact later on. Right? And so it really is a balance of enjoying life today and creating the retirement that you want later in the future. The Competent Retirement Approach is something Ameriprise put together that really takes a holistic view from a financial planning perspective and breaks down the process into personalized, actionable steps based on these 4 key needs: covering essentials, ensuring your lifestyle, things over and above your basic living expenses that you enjoy doing, preparing for the unexpected, and then leaving a legacy. So we'll go through these on an individual basis. First on the list is covering essentials, and they are exactly that, the necessities, the part of your monthly spending that covers your housing, your food, your clothing, the basic needs of living, right? And it's important to make the most of your income and build a reserve to cover these expenses now, but also ensure that you've got those expenses covered in retirement. In an ideal scenario, that basic part of your living essentials or your living expenses should be covered with a fixed income source in retirement. Right? A government pension is an ideal way to ensure that the benefit you have, the income you have in the future would actually be a great source of income to cover those basic needs. And then your savings and investing, we'll talk about, could cover the additional pieces of that. Okay. When we talk about covering the essentials, we're really looking at solutions for doing that. Part of that today is being able to maximize your savings rate, making the most of your income and monitoring your expenses so that savings becomes a regular part of what you do. Taking advantage of your workplace benefits, insurance programs, 401k or TSP matches, wellness programs, and even charitable giving match programs can all represent a significant portion of your overall compensation. And we'll talk more about how to maximize those benefits a little bit farther in the presentation. Ensure that your monthly expenses are covered with a cash reserve. Many of you have probably heard kind of the rule of thumb of 3 to 6 months of your expenses or your income in a cash reserve in case you can't work. Maintain that reserve during your working years and possibly increasing it in retirement, since you won't have a guaranteed or may not have that guaranteed income source, but you still need to have those expenses covered. Dollars that are set aside for your cash reserve should be liquid, checking, savings, money market, maybe CDs of a short-term nature. But if this is money you may need to tap in the event of an opportunity or an emergency, these dollars have no business being exposed to market risk of any kind. Okay. When we talk about maximizing your savings rate in general, it's really an exercise in finding money. So how do we do that? You'd be surprised how much found money there is and readily available cash that you're using in a way you might not even truly be aware of. We're all guilty of mindless spending, especially if we've got families. The money just seems to go. But if you think about, if I were to ask you how much money you make, you probably can answer me pretty quickly, or at least have a general idea. But if I were to ask you how much you spend, whether it's in a week, a month, or a year, and how much you need on a monthly basis, you'd be surprised how many people we come across who really don't have an idea. And it all adds up. We recommend, whether you're working with an advisor or doing this on your own, examine regularly your cash flow every 6 months, at least once a year. What's the money that's coming in and what's the money that's going out? And where are the spending areas that could be reduced if you needed to increase or build up your savings? It's most important that you treat savings that you're doing, both for a cash reserve and longer-term goals, like a regular expense. Savings should not be something that you're doing only if there's money left over at the end of the month. Pay less in taxes, right? What are the ways that we can reduce the taxes that you're paying and have you keep more of the money that you're earning? Contributing to a pre-tax retirement plan, IRA contributions are just a couple of the examples, and we'll talk more when we talk about some of the investment strategies, ways you might be able to reduce your taxes. One of the most important ways that we can find money is smart debt management. Paying less in interest, reducing your overall debts. There are good and bad kinds of debt. Good debt helps you generate income and increase your net worth. Examples include student loans, where you're investing in your education, and a mortgage. Bad debt, on the other hand, only manages to deplete your income and decrease your net worth. And examples are borrowing for consumption, car loans, vacations, furniture, things that are discretionary. One of the things we like to talk about is ways to pay down and better manage eliminating debt if you do find yourself in a situation where you've got multiple accounts or a lot of credit card debt or more than one credit line. We often find a lot of our clients will take a little bit of extra money each month and put it on each account. It's actually a very inefficient way to pay down debt. We recommend instead that you identify one account, either the highest interest rate or the lowest balance, and put the minimum on all the other accounts and pay any extra money you have only towards that one account. When that account is then paid off, take whatever it is you were paying that month to each month to that account and apply it to the next balance and continue to do that. What you will find, and what we have found in doing the analysis, it actually reduces the time that it takes to pay down the debt by almost half and substantially reduces the amount of interest that you pay when it's treated in this way. The other thing is be very mindful of the rates that you're paying on the different types of credit that you're using. And speaking of that, have you looked recently at refinancing your mortgage? Does it make sense? 30-year rates are still below 4%. 15-year rates can be below 3%, depending on your existing balance and your credit rating. So if you haven't looked at the current interest rate you're paying and whether or not it's advantageous to refinance your mortgage, you may want to think about doing that. Let's talk a little bit about maximizing your workplace benefits. Right? I mentioned earlier contributing to a pre-tax retirement plan. You'd be surprised how many people we come across who are not contributing to the TSP or their employer's 401k with at least enough of a contribution to get the match. You are walking away from free money if you are not doing that. A recent study that was done by Aon Hewitt found that 27% of 401k participants don't contribute enough to get their full match. And the number's even higher among younger workers. I don't know about you, but I don't know a lot of places where I can get 100% return on my investment simply by making the contribution to my TSP or a 401k plan. And remember, you can always save beyond that minimum, beyond that matching amount, up to $18,000 a year if you are under the age of 50, but with the catch-up rules, $24,000 a year if you are 50 and older. And doing so into a traditional plan can also save income taxes. Again, found money, as we talked about. Life insurance. Another of the workplace benefits worth exploring are what are the life insurance benefits that are available to you. Depending upon your age and health status, insurance coverage offered through an employer may in fact be cheaper than purchasing the same coverage on your own. Disability insurance. Disability insurance provides income replacement in the event that you are unable to work due to illness or injury. The benefit for FERS employees is that after 12 months, the first 12 months you would get 60% of your income if you're unable to work, and after month 12 that percent drops to 40%. I don't know of a lot of people in the Washington, D.C. area who could live on 40% of their paycheck. So while your government, the FERS disability benefit is very valuable, it might not be sufficient to cover all your needs. And we'll talk about that a little bit later in the protection planning section about whether or not it makes sense for you to supplement that coverage. But know what your workplace benefits are and what those would provide in the way of benefits for you and your family. And it's definitely worth considering. Health insurance. Even with the changes that came about through the Obamacare legislation and recent health care legislation, group coverage offered through your employer is still the most cost-effective way to provide health insurance coverage for you and your family. That said, though, you need to make sure that you and your family that you're choosing the right plan. If you are relatively healthy and you are not a high consumer of medical services, you may want to consider a higher deductible, lower premium plan. Now, it means that you take on more of the risk in the event of a catastrophic illness or a year where you may use more medical services, but evaluate your plans to see the difference between the premium you will definitely pay versus your deductible, and whether or not it's worth taking a little bit of that deductible risk on yourself to save potentially hundreds of dollars a month in the premium cost. Your benefits coordinator can help you evaluate which one is the right one for you, but oftentimes we see people taking the highest level of coverage, but they may go to the doctor twice a year and they're not really getting back any benefit in the way of the coverage. So it's worth looking at for your situation. And doing so could increase your monthly cash flow. Flexible spending accounts. This is another workplace benefit that a lot of times is ignored. These are where you can set aside money through a dependent care account or a medical flex account for expenses that you know you're going to have, and you can save into these plans on a pre-tax basis and then use them to reimburse yourself for child care expenses and medical expenses like eyeglasses, contacts, your deductible, doctor's visits, etc. The great thing about these accounts is that you never pay taxes on these dollars, but the downside is that the dependent care accounts and the flex spending accounts are use or lose plans for the most part. So be sure that the money that you're putting in is what you expect to spend that year. And it's better to err on the side of underestimating and contributing less, because if you don't end up having expenses that you can get reimbursed for, you lose the dollars that you put in. Health savings accounts are a little bit different. You recall on the health insurance side, I mentioned a high deductible plan. These plans allow you to use a health savings account, and they determine the amount that you can put into the health savings account every year. These dollars also go in pre-tax, and they can be used to pay for your deductibles and your other medical costs. The beauty of these accounts is that there is no use or lose. They continue to roll over. So if you don't use the dollars in one year, but you have higher expenses in the next, you can actually use them later down the road or the following year. And anything that's not used works like a retirement account at the time you retire. In order to get access to these plans, though, you need to have a higher deductible medical plan, which determines the amount of dollars you can contribute to the plan. But again, a way to cover some of your expenses in a pre-tax way that reduces your taxable income and ultimately reduces your total tax liability. And lastly, if there are prepaid legal services or other types of these services available, reduced cost plans that allow you to have legal documents such as wills, trusts, powers of attorney drafted for you, it's often at a much lower rate than if you went to see a private attorney. Once you've covered all the essentials, then we talk about ensuring your lifestyle. These are the things over and above your basic living needs that you enjoy doing, that you want to do, the discretionary things. So it's a balance between doing those today and saving additional dollars for the future to ensure that you can still do some of those in the future as well. When we look at ensuring your lifestyle expenses, we're really matching the savings needed for a particular goal to your assets. We consider the tax impacts and then develop a smart investment plan for each of those goals. We would recommend that you break down those goals into 4 categories. Short-term goals, which are between 1 and 3 years away. Medium to long-term goals, which are over 3 years but sooner than 7. Education and retirement are typically treated differently or separately. When we talk about the different types of ways that you can save for different goals, there's really 3 different types of accounts from a tax perspective. Taxable accounts, tax-free accounts, and tax-deferred accounts. And depending on the goal, there may be benefits to one or more of these accounts for a specific goal. A taxable account is where you put money in after tax. You've already paid your income tax on it. Any earnings that the account has during the year are subject to income taxes. And Depending on how you take the money out, whether it's a withdrawal or you have to sell something in order to use the dollars, there could be taxes on the way out as well. These types of account are typically your savings and investing accounts that are not part of a retirement plan. We call them non-qualified accounts, and they are not a 529 or special education type account. Tax-free account. Tax-free account also has money going in after tax or tax-free investment. You don't pay taxes on the current year earnings, and you typically don't pay taxes on the money coming out. There's very limited options in this category. Municipal bonds as a type of investment tend to be one. Roth IRAs or Roth 401ks tend to be another, and cash value life insurance, right? The TSP has a Roth 401k component to it. It is recommended that you consider the benefit of contributing part of your dollars to a Roth, because when we talk about limiting taxes, it's not only in the current year, but you also want to be mindful of where that's going to place you in the future and whether or not the benefit of tax-free for the rest of your life, which a Roth account is, outweighs the current tax deduction of putting the dollars into the pre-tax side of the 401k or the TSP. Lastly is the tax-deferred account. This is where you actually have pre-tax money going in, although some plans do allow you to contribute after-tax dollars as well. You do not pay taxes on the current year earnings, but they are not tax-free. You're simply deferring the tax or delaying it until you pull the money out, and at which time all of the income is taxed as ordinary income. Okay, this would be your TSP account, tax-deferred annuity. 529 plans would fall into the tax-free bucket, provided when you pull the money out, they are used for qualifying education expenses. And those expenses, just to go back there, those expenses must be for post-secondary education. You cannot use a 529 plan to pay for private middle school or high school. It must be post-high school. And basically anything that you can apply for financial aid for can be used against a 529 plan. So semesters at sea and other types of trade and vocational schools, if you can fill out a FAFSA form or apply for federal financial aid, then those expenses would qualify for the tax deduction or the free tax treatment on using 529 plan dollars. That said, when we look at the different types of buckets, the tax-free, taxable, and tax-deferred, the best savings and retirement plan is where you have some money in each of these buckets that you're saving into today and planning on pulling out of in retirement. It gives you more flexibility to control the tax treatment of different income streams when you need the money in retirement. Unfortunately, what we typically find is that 80 to 90% of a client's retirement assets are in the tax-deferred bucket, meaning they have no option but to pay ordinary tax on all the money coming out. The best case scenario is where you have about 40 to 45% in the tax-deferred bucket, and the remaining amounts are distributed between tax-free and taxable. For most people, depending on your income, the only way to get dollars into the tax-free account, because most people's income is too high to be eligible for a Roth IRA contribution, is using the Roth TSP account. 529 plans for education, but if you don't use them specifically for education, they incur a 10% penalty on the earnings. So it's not something we recommend you overfund because of the penalty. My screen has frozen. There we go. Once you've figured out what you need to save, that you've calculated what you need to put in saving for education, what you should be saving for retirement, then you need to figure out how to invest the dollars for those specific goals. The shorter the time frame, the more conservative the investment strategy should be, the less risk you want to take. The longer the time frame, the more risk you can afford to take, depending on how much time you have to recover from a market correction. This just shows what is typically considered a conservative allocation, which would have more more bonds or fixed income than stocks. And as you move through the risk profile, the allocation of bonds to stocks typically changes. We never recommend 100% of anything. Even our most conservative portfolios, we would not recommend 100% in fixed income. And our most aggressive, we would not recommend 100% in equities. The allocation, typically for a conservative portfolio or someone whose risk profile would indicate they're not willing to accept a substantial amount of loss, would probably be 60 to 70% fixed income and 25 to 30% stocks. When you move into a moderate portfolio, you might be more balanced with either 50-50 or 60% equities, 40% fixed income and cash. And the aggressive portfolio is typically a 70-30 or 75-25, where you have 75% of your portfolio in equities and 20 to 25% in bonds and cash. Again, the risk profile should be aligned with the savings need. What are you saving for, and when are the liquidity events for those dollars? When will your children use them for education? When will you use the dollars for retirement? But most specifically, you need to evaluate the portfolio in terms of what the potential loss is in dollar value or percent, and make sure you are comfortable with what that could mean in a given year. An aggressive portfolio, if you think about 2008 and what the market did in terms of a downturn, could result in a worst case year of 35 to 40% loss. If you're not able to sleep at night with that kinds of risk, you should not be taking that kind of investment risk and having that kind of portfolio. The implication is the more aggressive you are, the more potential for return, the less you might need to save, but you need to align those portfolios with what it is that your comfort level and your tolerance for loss. Okay. Once you've identified the buckets that you need to save into to ensure your lifestyle expenses, we want to talk about the things that could get in the way of you enjoying your life today and preparing for the future. These are unexpected expenses, and in this area, we're talking about protection planning, protecting the things that you can't afford to lose. When we talk about protection planning, we're typically talking about insurance-type products where you are identifying a financial risk that could result from an event and deciding whether or not to accept that risk, knowing that you will have to change your lifestyle or your plans if that risk happened to you, or whether you want to transfer that risk, all or in part, to an insurance product. We're talking about protecting your income. Your ability to earn an income in your working years is arguably your single most important asset. A lot of times when I do seminars in person and I ask, what is your most valuable asset? The answer I usually get is my house or my 401k plan. I would argue it's actually your ability to earn an income. If you were to think about the income that you are going to earn if you're planning on working 10, 15, 20 more years, that number is sizable. And what is the risk to your family if you are not able to continue to earn that income? That feeds into the next one, which is protecting the people you love and causes that are important to you. Here we're typically talking about life insurance. Disability income protection replaces your income if you are still here but unable to work. Life insurance replaces your income if you are not here and all of the income that you would have earned is now lost to your family. And then we'll talk about protecting some additional risks. Coming back to some of the workplace benefits, typically what we find is that your life insurance that you're able to get through work and the disability income protection that you have, as we talked about on a longer-term basis, only 40% of your salary if you're FERS, is not usually sufficient to cover the risk. On the life insurance side, we typically find clients think of paying off a mortgage or putting money in an investment account so I could pay for my kids' education. What they don't always think about is the lost income that would need to be replaced for your family if you were to die prematurely and not able to continue earning that income. In the insurance world, there is a calculation called human life value that takes a look at the net present value of all of the earnings over the course of your lifetime and calculates what you would need in an insurance policy to replace that income. Very few people realize that for every $40,000 to $45,000 of income you need to replace for your family, you need $1 million of life insurance to provide that coverage. If you are earning $65,000, $70,000, $80,000, it's not uncommon that you could need $1.5 million, $2 million, even $3 million of coverage during your early years to ensure that your family would be able to maintain their lifestyle if you are unable to, if you were to die prematurely and not able to continue working. So we do recommend that you look from a cost perspective at your workplace benefits to see if they are cheaper and more affordable, but oftentimes it is necessary to go out to the private insurance market and supplement that coverage. Okay. After you've addressed protecting your income and then protecting your family from a premature death, the other areas of protection we encourage you to take a look at are your property and casualty insurance. This is your homeowners, your car insurance. An umbrella policy actually is a liability policy that ties your home and your car insurance together and raises the liability limit. It's a good idea to review that together with your property casualty person or your financial advisor on an annual basis. If your situation exposes you to additional risk, it's very unfortunate, but in our society, it's a very litigious society, and people oftentimes don't think twice of suing after an accident or an injury that's caused by someone. If you have a rental property, you are at increased risk. If you have teenage drivers, you are at increased risk. And it's very inexpensive to have an umbrella policy that raises your liability limits to $1 million or $2 million for $100 or $200 per year in additional premium. The other area we look at once the life and the disability are covered is the issue of long-term care. Not a fun topic to talk about, but the statistics in the United States are that 1 in 2 over the age of 60 will at some point need help with the activities of daily living or custodial type care. These costs in today's dollars in the Washington area can be as high as $70,000 a year, $5,000, $6,000, $7,000 per month to have the help you need if you're not able to take care of yourself or a loved one. Long-term care insurance is a way to transfer that risk so that if you need that coverage or that help, that you're not using your own assets to pay for that coverage. We typically recommend clients consider looking at long-term care insurance around the age of 50, earlier if there's a family history of an illness that can increase your risk to need long-term care. It becomes much more expensive by the age of 60. So between 50 and 60, it's actually cheaper than waiting till 60, 65, or later to try and obtain that coverage. Okay? And lastly is then leaving a legacy. This is the estate planning part. This is about how you want to provide for your family and how you want to be remembered if there are causes that are important to you. First and foremost is ensuring your family will be well taken care of, both financially and otherwise. It's important that you make your wishes known and update your estate documents. I'm going to talk about some of the basics from an estate planning perspective. For most people, estate taxes are no longer an issue, with the estate tax exemption amount having been increased to over $5 million per person. A married couple can protect up to $10 million of assets without worrying about estate tax. But that doesn't mean that you don't need estate planning documents. In the most basic form, you should have a will, a health care directive or power of attorney, and a financial power of attorney. This is especially important if you have minor children. Minor children, cannot own property. So if you have children named as beneficiaries on life insurance or retirement accounts and they are under the age of 18, I highly encourage you to change that designation that would at least put the dollars into a custodial type account and name someone else to manage those accounts for them until they are 18. Failure to do so will require the court will need to appoint a conservator to manage those assets for you. It's also important that a will name your choice for a guardian if, God forbid, both parents were to die prematurely. Someone who would provide for the love, support, the day-to-day aspect of caring for them, as well as someone who would manage the financial assets, a trustee, and have provisions in your documents that if you have underage children, think about at what age you would ultimately want them to receive a potential inheritance. Do you think they could manage your retirement accounts, a property, $1 million of life insurance at the age of 18 and have any left by the time they're 25? Or do you want to have the assets remain in trust until they're older? These are discussions you should have with your financial advisor, with an estate attorney, and within your family to figure out who you might appoint for these key roles of guardian and trustee. Trusts are let me go back up to the digital accounts. In today's world of everything being online and online banking and online accounts, it's very important that someone other than you know how to access those accounts, that you have in a safe place, whether it's a locked safe deposit box that your partner or someone else has a key to, a listing of all your online accounts, your passwords, and et cetera. One of the other things that people don't realize is that reward accounts, frequent flyer points, American Express miles, those are inheritable assets. And if your family doesn't know about them, you may have hundreds of thousands of points equivalent to thousands of dollars lost to the family simply because they didn't know how to access the account. Okay? A basic estate plan will have a will, the financial and medical powers of attorney. And I tell clients, and estate attorneys will tell you, if you do not have a will, the state that you reside in has one for you, and you may or may not like what it says. Trusts come in multiple forms. A living trust or a revocable living trust is something you create during your lifetime. And for a lot of clients, it's considered a more complex estate plan, but it can be a good planning tool that both ensures that you could be provided for in the event of your own incapacitation. It also allows you to control the distribution of assets in the event of your death. You can create trusts through a will, but you can also create them during your lifetime and put assets into them. One of the big mistakes we see oftentimes with clients is that they went to the trouble and the expense of consulting with an estate attorney and creating revocable living trusts, and then they never actually did the second step, which is retitling assets and leaving assets to the trust as beneficiary. So all of the estate planning work is basically ineffectual because they never funded the trust or made the trust the beneficiaries. We recommend you do a review on a regular basis of how your assets are titled and understand how they would pass in the event of death so that you're sure everything, anytime you open a new account or change employers, anything like that, that you've accounted for all of those things. Those are basically the areas that we recommend you consider working with a financial advisor or on your own, covering the essentials both today and in retirement, ensuring your lifestyle expenses. These are the fun things over and above your basic living expenses that you want to be able to do now and in retirement. Preparing for the unexpected, evaluate your protection planning needs. A major life event such as marriage, divorce, having children changes your protection planning needs. Financial planning is not a one-time thing. It's an ongoing process that's designed around you and your current and future desired situation. And lastly, on the estate planning side and leaving a legacy, make sure that you've thought through how you want to provide for your loved ones and any causes that you're passionate about, and that your documents and your account ownership and beneficiary designations are in line with that. I don't know if you've seen any of the ads, but Ameriprise believes that working with a financial advisor and addressing these things early on, you can have balance today, and life can be brilliant. It can be whatever you want it to be. That said, we do offer a complimentary initial consultation to go through some of those things, do a check of where you are today in relation to those and where you want to be. Our contact information is on the screen if it's something that you're interested in. But what I'd like to do now is just open up the floor for questions. I'm happy to answer questions about anything that was covered here or questions you may have about a situation you're facing or something maybe I didn't cover that you wished I had. There's not actually a queue. You can just unmute your phone and ask the question if you like.
Hi, my name is Kim, and on public broadcasting, they've had a couple of shows on there that is really encouraging investment in index funds, saying that a variety of other types of savings mechanisms in the stock market, the fees are so high that it really hurts you, and that and it takes a lot of your money away, and how these different kinds of index funds are better. Could you comment on that?
Certainly. So what you're really talking about is there's a debate in the investment world about active versus passive investing. Index funds are what we call passive investing. They're low-cost instruments, but they typically hold everything that's in an index, and they only make a change when the index changes. So if you think about an S&P index or a spider, it's going to hold the 500 companies in the index, and unless S&P changes the companies in the index, you're going to match what the S&P is doing. You are correct in that actively managed mutual funds, which try to outperform the index, do have higher expenses than an index. And in certain asset classes, large company stock being one of them, it is very difficult to consistently outperform an index. And in fact, a lot of, quote, actively managed mutual funds really end up what we call hugging the index, and they measure their performance against an index. And frankly, I believe if you're not going to be able to outperform the index and you're going to hold what's in the index, I would absolutely recommend that a client simply hold an index fund or an ETF with much lower expenses. Anytime you consider an investment purchase, you need to know what the explicit and implicit fees are. All investments, including index funds, have internal expenses that are the difference between the gross rate of return that a fund would earn or that your investment would earn and the net rate that you are credited with. If you're investing online, you can find that in the prospectus. If you're working with an advisor, you should be asking the question, what are the fees associated with? What are you charging me, and what is the fund charging me? So you know what your net, your true overall expense is. So I believe index funds in certain asset classes, in many asset classes, are a more cost-effective way. The downside of an index fund is you will participate both on the up and the downside. So you will never outperform the index. You will simply follow it.
Okay, thank you very much.
Hi, I had a question about TSP contributions.
Certainly.
And I know there are limits on different things, and so, but I think I heard you say that even though maybe I couldn't contribute to a Roth because of earnings level, I still could within my TSP. Is that correct?
That's correct. So a Roth IRA, in order to make an active or current year contribution, there are income limits. And if you earn over a certain amount, depending on your tax filing status, single or married filing jointly, you may or may not be able to make a full or a partial contribution. However, when your employer, when the TSP plan offers a Roth option in a 401k, there are no income limits assigned to it. So regardless of your income, if your employer offers the Roth option, you can choose to put some or all of your retirement plan contribution in that Roth. Now, the important thing to realize is that your employer match will only go into the traditional account. Employers do not match into a Roth because they get no tax savings for doing it. But you can still do some or all of your contribution into the Roth TSP. I often recommend, because as we've talked about balancing, it's a balance of, do I do the traditional 401k or TSP and get the current tax deduction, or do I give up the current tax deduction and put the money in a Roth so that the assets can grow for the rest of my life tax-free? It's a balance. I usually recommend clients split their contributions between the two. The Roth 401k is one of the only ways that a lot of our clients have available to get money into that tax-free bucket.
Mm-hmm. Okay, and then the maximum contribution anybody can make in any given year is $18,000.
So if you're under the age of 50, it is $18,000. But once you hit the age of 50, you're eligible for what's called a catch-up contribution, which is typically done separately, other than the percent that of your salary that you're normally doing, and you can contribute up to $24,000 total if you're eligible for the catch-up.
And that's just your contribution, not the
Correct.
matching.
That is yours. That does not include the government matching or an employer matching.
Okay. All right. I'll learn something new. Thank you.
Wonderful.
Hi, could you read the number for the consultation out loud for those of us who are actually not looking online but just listening by phone?
Certainly. You can call our office at 703-663-1157, or you're welcome to email either myself, which is just my name, rebecca.b-like-boy.hall@amplikefrank.com, or you can reach my executive assistant. Her name is Jordan Satterfield, and she would be the one answering the call. So that is her number, the 663-1151 number. We do have offices both in Reston, Virginia, and downtown D.C. at International Square, and so we'd be available to do a consultation at either of those locations.
Thank you.
You're welcome. Any other questions?
Yeah, I've got one. First of all, I'm curious if you could reiterate what that offer is in terms of consultation. Is there a discount or something, or?
So the consultation is in fact complimentary. It's a chance to talk about what it is you're doing currently, what you're planning for in the future. It's a chance for us to explain who we are and what we do as advisors and see whether we can help you from a financial planning perspective. So it's a 90-minute, up to 90-minute consultation to evaluate where you are and see if we can help you from a planning perspective.
Okay, and that's only available in person. I'm calling in from way outside of D.C.
It's better in person, but we can certainly arrange a phone call if that's more convenient. If you're remote.
If you're in Hawaii, that would be more convenient.
We are in fact licensed in Hawaii. We've had several of our clients move to Hawaii. So yes, we can certainly do that by phone or GoToMeeting or a WebEx.
Oh, okay, great. So maybe I'll do that instead of asking the question I was about to ask.
Okay.
So.
Hello. So I have a general question in relation to, pardon me, how you evaluate the consolidation of multiple funds from various past employers, whether that's beneficial, besides not having to track them all individually, if it is beneficial to consolidate those types of investments.
So we typically believe that it is beneficial to consolidate them, and then your options are, do I consolidate them into my current employer's 401k, or do I use an individual retirement account? And so the answer to that question depends on a couple different things. It depends on when you're planning on retiring, and the reason is that assets in an individual retirement account or IRA have a or early withdrawal penalty if you use them before 59 and a half, unless you are taking what's called substantially equal periodic payments. In a 401k or TSP plan, however, if you retire early, you can access those funds as early as 55 with no early distribution penalty. The other thing to consider is your line of work. If you are exposed from a professional liability perspective, not all states protect IRA assets the same way they protect 401k assets from liability, from bankruptcy, and other things. So it's important to know those things depending on your line of work and just understand the implications. It may also depend on the different investment options that you have available to you in the employer plan. If they have options you can't get somewhere else, or if they don't have enough options, you may want to consider an IRA. But there really is little to no justification for keeping assets in an account at an employer you no longer work for, unless you think you may go back and there is an unvested matching contribution or profit sharing contribution that you would lose if you close the account.
Thank you.
You're welcome. Any others?
I guess I do have one other question. What's your, you know, I'm fairly young. I'm not yet 50. In fact, I'm not yet 45. My husband and I have been talking about the fact that it would probably be a good idea to have a will, just in case, sort of thing. But, you know, when you do the risk benefit or the risk management on it, the likelihood that we're going to use it in the next 5-10 years is somewhat low, right? So what's your opinion on things like LegalZoom and those kind of services where you download a generic boilerplate document, you go to a notary?
So estate planning documents are actually not written for you. They're written for the attorneys who are going to deal with your estate in the event something happens to you. And again, not to kind of knock LegalZoom or having a friend who's an attorney do your documents, but in particular with estate planning law, the worst situation that you can be in is where the documents are not clear. Because by definition then, you are looking at a court situation or other complexities or drawing out the process because something in the document wasn't clear. We recommend clients see not only an attorney, but an attorney who specializes in estate law when they're drafting wills, powers of attorneys, and trusts. And the reason is most attorneys, and this is not to knock attorneys, but if you ask them whether or not they understand wills and trusts, if they're honest, they may have taken 1 or 2 classes in law school. If it is not their area of expertise, they are not keeping up with the specific laws in your state and federal laws around estate tax planning and other things that could impact your documents. For a power of attorney, you might be fine doing something like LegalZoom, but for wills and trusts and that sort of thing, we highly recommend you see an estate specialist, someone who does estate law and estate administration.
Okay, what does that typically run for a fairly straightforward will without?
It depends on whether you're in D.C. or outside D.C., and whether you're looking at a simple estate plan, which is wills and powers of attorney. But I would say on average, it can run from $1,500 to $3,000. The real issue about whether you need a will, the will governs assets that do not pass by either right of ownership, so we hold something jointly, and if I die, he or she will inherit it automatically, or because you have a beneficiary designation. If you have no assets that you can't put a beneficiary on, or you can't own jointly with someone, and you don't have minor children, you may be fine to just have the power of attorney documents and make sure that everything could pass by right of ownership or by beneficiary designation. A will is there to clean up your estate if you have something that can't pass by one of those 2 ways. So if you are,
thanks.
Okay.
Yeah, that's good. Thank you.
You're welcome. Are there any other questions?
I just had a quick question. If we wanted to leave money to, say, something like our college, is it important to check in with the college's development office first to see if they have certain standards?
I don't know of any charity that's going to decline money. There's a couple different ways you can do it. You can either do it as part of a bequest in a will, or you can do it as a percent or a partial distribution as a beneficiary from an account. You may or may not need to check with them if, for example, you want to leave real estate. They may or may not accept real estate. But on financial assets, they're not going to say no, but I would typically inform them because they do track future gifts often. So they just want to know that they've been named in someone's document.
Okay, thank you.
You're welcome. Okay, well, if there are no other questions, I want to thank you all for spending a part of your afternoon. And I hope the presentation was helpful. And if you have questions or are interested in consultation with myself or one of my associates, please feel free to get in touch.
Thank you.
Thank you so much, Rebecca.
Thank you. You're welcome.
Thank you.